Have you ever imagined a scenario like this? Tomorrow morning, the global stock market suddenly crashes by 50%, and the price of almost everything we buy suddenly doubles overnight. It sounds like a scene from a financial disaster movie. But what if I told you, the trigger might not come from the United States or Russia or even Europe? What if it came from just one country, Iran? Right now, the war between the United States and Iran is turning into long-term conflict. Officially, the conflict started because of one thing, Iran's nuclear program. But behind the headlines, many geopolitical analysts believe something much bigger could be at play. Because if Iran collapses, the country that could suffer the most might not even be in the Middle East. It could be China, the world's second largest economy. For years, Iran has quietly become one of the most important pieces in China's long-term economic strategy. Energy, trade routes, currency power, all of it connects through Iran, which raises an uncomfortable question. If pressure on Iran continues to rise, is this really just about nuclear weapons? Or is it also about weakening one of China's most important strategic partners? To understand why this matters, we need to look at the hidden economic chain connecting Iran and China, and once you see it, you'll start to understand why. Beijing is watching the situation very carefully right now. Let's start with a simple question. What is the real engine of the Chinese economy? It's manufacturing. China's giant factories run day and night, producing everything from smartphones to solar panels to electric vehicles. But factories need one thing above everything else: energy, and a lot of it. China is actually the largest oil importer in the world, which brings us to Iran. When the United States and Western countries imposed heavy sanctions on Iran over its nuclear program, Iran suddenly lost access to most global markets. Its oil exports collapsed. Its economy was pushed to the edge. But then one country quietly stepped in. China. China started buying large amounts of Iranian oil, but not at normal prices, at deep discounts. In many cases, Iranian oil has been sold far below global market prices, and it often travels through what experts call ghost fleets. Tankers turn off their tracking systems in the middle of the ocean. Documents are altered. Oil shipments are relabeled as coming from other countries, and eventually, they arrive at private refineries in eastern China. This system has allowed China to save tens of billions of dollars on energy every year. Cheap oil means cheaper manufacturing, and cheaper manufacturing means Chinese products stay extremely competitive in global markets. But now imagine this. What if Iran collapsed and established new government? Regime change. That entire supply of cheap oil could disappear almost instantly. China would suddenly be forced to buy oil at full international prices, and that would drive up costs across its entire manufacturing sector. Factories would face higher production costs. Some would shut down, others would raise prices, and China's biggest economic advantage, which is its low-cost exports, could start to weaken. But oil is only part of the story. The real reason China fears instability in Iran goes much deeper. It involves something even more powerful than energy: money, more specifically the global currency system. Today, most international trade, especially oil, is conducted in one currency, the US dollar. This system is often called the petrodollar system, and it's one of the main reasons the United States maintains enormous global financial power. But China wants to change that. China wants the world to use its currency, the yuan, and Iran became a key testing ground for that idea. Because of US sanctions, Iran has limited access to the global dollar system. So China offered an alternative: we'll buy your oil, but we'll pay in yuan. Iran accepted, and slowly, a new financial network began forming between the two countries. China paid for oil using yuan. Iran then used the yuan to buy Chinese goods, equipment, and technology. This allowed China to expand the use of its currency while avoiding US financial oversight. But if Iran collapses, that entire system could break down. China would lose one of the biggest examples, showing that oil could be traded without dollars, and that would weaken China's long-term plan to challenge the global dominance of the US dollar. But the stakes get even bigger, because Iran also sits at the center of one of China's most ambitious geopolitical projects, the Belt and Road Initiative, often described as the modern Silk Road. This project aims to connect China to Asia, the Middle East, Africa, and Europe through massive infrastructure networks, railways, ports, highways, energy pipelines. And if you look at the map carefully, you'll notice something important. Iran sits right in the middle of those routes. Geographically, it's one of the key bridges connecting Asia and Europe. That's why China signed a 25-year cooperation agreement with Iran, worth roughly $400 billion. Chinese companies have invested heavily in infrastructure across the country: ports, railways, telecommunications, energy facilities. But if Iran collapsed, much of that investment could be at risk. Construction projects could stop, infrastructure could be damaged, trade routes could be disrupted, and China's modern Silk Road could lose one of its most critical links. And then there's another factor: natural resources. Iran isn't just rich in oil, it also holds large reserves of minerals like copper, zinc, and iron ore, resources that are essential for industries like renewable energy, electronics, and electric vehicles. China's manufacturing sector consumes enormous amounts of these materials. If supply chains from Iran are disrupted, global commodity prices could spike. Factories across China could face shortages. Production slows, exports drop, and economic pressure builds. Now imagine all of this happening at the same time. Cheap oil disappears, infrastructure investments collapse, supply chains break down, financial networks freeze, and all of this hits China at a moment its economy is already under pressure. Real estate is struggling. Local governments carry massive debt. Youth unemployment has reached record highs. If a major external shock hits now, China could face something economists fear the most: stagflation, rising prices, slowing growth, factory shutdowns, and eventually, political pressure, which is why the current tensions around Iran are making Beijing think very carefully. Because what looks like a regional conflict might actually reshape the global economic balance. Officially, the United States says the goal is simple: stop Iran from developing nuclear weapons. But geopolitics is rarely that simple. Weakening Iran could also weaken one of China's most important economic partners. Energy supply, trade routes, currency influence, all of it runs through Iran. So the real question now is this: if the war on Iran continues, how will China respond? Will Beijing step in to stabilize its partner? Or will this become the first domino in a much bigger global economic shift? Because in today's world, geopolitics isn't just about war. It's about supply chains, currencies, energy and economic power. And right now, China is watching very closely. So what do you think? Could the conflict around Iran reshape China's economic future? Or will Beijing find a way to protect its interests? Let me know your thoughts in the comments below. And if you want more deep dives into the hidden economic battles shaping our world, don't forget to subscribe and turn on notifications.